teaching a course on the new revenue recognition standard, and at the break the controller stopped to ask me whether or not the new revenue recognition standard would impact his revenue recognition policies. This company basically placed scaffolding on a building for use by construction companies. And this company basically used the percentage of completion method to recognize revenue from the point in time in which they started to erect the scaffolding through the period of use till the scaffolding was dismantled. And he asked me, is this going to affect my revenue recognition policies? I told him that step 5 really would be his key to determine whether or not his accounting policies would change. In this edition of GAAP Chats, we're going to talk about step 5 of the new 5-step model within ASC Topic 606, Revenue from Contracts with Customers. To recap, in previous GAAP Chats, we've already been through the first 4 steps. Step 1, identify the contracts with the customer. Step 2, identify the performance obligations within those contracts. Step 3, determine the transaction price. Step 4, allocate that transaction price to the various performance obligations. And here we are in step 5. We're going to recognize revenue when or as the entity satisfies those performance obligations. Now, the key consideration for step 5 is control. And really, under step 5, we're going to recognize revenue either over time, such as the scaffolding company was doing using the percentage of completion, or at a point in time. This is good news for our scaffolding company, right? It looks like they can still use the percentage of completion method because step 5 does allow for revenue recognition over time. Not so fast. In order to qualify for revenue recognition over time, one of 3 criteria need to be met. The first, the customer receives or consumes benefits as the entity is performing. A perfect example of this would be a lawn maintenance contract with a monthly fee. Essentially, the entity, the lawn maintenance company, would recognize revenue over the period of time of the contract. The second criteria for revenue recognition over time, the entity's performance creates or enhances an asset that the customer controls. Take, for example, General Dynamics. They build nuclear submarines for the U.S. government, and these nuclear submarines take 10 to 15 years to complete. Would General Dynamics qualify for revenue recognition over time? You bet. Why? Because who controls that nuclear submarine? If you said the U.S. government, you'd be right. The third criteria for revenue recognition over time is the entity's performance does not create an asset with alternative future use to the entity, and the entity has enforceable right to payment for performance completed to date. Let's take a look at the General Dynamics example again. Does a nuclear submarine have alternative future use to General Dynamics? Doubtful, because they're not exactly allowed to sell the nuclear submarine to another country. So actually, General Dynamics would qualify under the third criteria as well for revenue recognition over time. Now, if you don't qualify for one of these criteria, you're forced to wait until control passes to the customer at a point in time. What types of factors will we look at to determine when control is actually passed to the customer? First of all, we're going to look and make sure that the entity has the present right to payment. Does the customer have legal title? Do they have physical possession of the asset? Have the risk and rewards of ownership transferred from the entity to the customer? And has the customer accepted the asset? Now, this is not an all-encompassing, it's not a checklist, they don't necessarily have to meet all of these criteria, but you're going to have to look and make sure to determine when control passes to the customer. Let's look at a practical example. Jackson Homes is a custom home builder that builds homes on land that you own. Justin and Paige Cooper, who are newly married, received a beautiful lot in the woods as a wedding present. They've engaged Jackson Homes to build their home on their lot on January 1st. The home is completed in November on schedule. Should Jackson Homes recognize revenue over the period of construction, or should they wait until control is actually passed to the customer? Do the Coopers receive or consume benefits as the entity is performing? That's doubtful. It's not like they're going to live in a half-built house. However, does the entity's performance create or enhance an asset that the Coopers actually control? In this case, because the Coopers own the land, we would deem that actually they control the asset as well, and therefore Jackson Homes would recognize revenue over time. Let's revise the example just a bit. Everything's the same. The only thing that's changing is that Jackson Homes is now building the home on a lot that they, Jackson Homes, owns. Does this change the revenue recognition policies? Sure does. Why? Well, they don't meet this. We've already said that. Now, because the entity's performance creates or enhances an asset, the customer, because it's not on their lot, no longer controls it. If we go to step 3, we have to ask ourselves, does a home have alternative future use to the home builder? In other words, if the Coopers don't buy it, could they sell it to someone else? They definitely could. And that's why in this revised example, Jackson Homes would have to wait until they deliver the asset to the customer to recognize revenue. Let's go back to the scaffolding example and see whether or not they would qualify for revenue recognition over time. Criteria 1, one could argue, customers not receiving or consuming benefits as the scaffolding is being erected. It's not even done yet. Criteria 2, does the customer control the asset? Do they actually control an asset that they can't even use yet? Doubtful. Really, the key to the scaffolding company and whether or not they can use the percentage of completion lies in criteria 3. The scaffolding does not have alternative future use to the scaffolding company, so that's good. And really, it's the second part of it. If the scaffolding company has an enforceable right to payment for the percentage of completion, then they would meet this third criteria and could continue to recognize revenue over time. If, however, they didn't have an enforceable right to payment, they would have to wait until basically the scaffolding was ready to be used by the customer, and then they would recognize it while the customer is using it. Now, what if you're required to audit step 5? You need to understand and document the client's revenue recognition process and policies for recognizing revenue at either a point in time or over time. You need to review the contract terms and conditions and verify that management has recognized revenue appropriately. You need to identify the what could go wrongs and test the controls associated with determining whether revenue should be recognized over time or at a point in time. If the client recognizes revenue over time, you need to challenge management's assumptions and gather corroborating evidence to support that they meet at least one of the 3 criteria. You need to assess management's method for recognizing revenue over time using either input or output measures and verify that the method used reflects the transfer of control of the various performance obligations. If the client recognizes revenue at a point in time, you need to inspect supporting documentation to determine when control actually transfers to the customer. We hope this has helped you better understand step 5 of the new 5-step model. As always, contact us with any questions you have on application of GAAP. This presentation has been brought to you by GAAP Dynamics.